right, Howie, how are you? Happy Friday.
Happy Friday, buddy. Good. You look great. You look great. And I'm not fishing for a compliment. You just look good.
No, you look amazing. You're much better dressed than I am. I'm just wearing my standard Go Long t-shirt, but you've got the golf. Are you playing golf today? I assume.
No, I had an LP pitch today, and what do you? The odds that I'm wearing pants. What do you think?
Well, I'm wearing shorts, which is my standard outfit. I hope you're at least wearing shorts.
I'm not wearing shorts.
All
I
right.
need to get out of the house. My wife was probably pissed because I have this home office, but I finally got an office, and I sometimes just like being at home.
What? Right.
Mark was up today, and I was like selling some stuff.
Stay home. Green.
I just haven't left. I don't want to change the mojo one up day.
Well, let's jump into it because we've only got a half hour. Everybody knows who you are. You're a legend in investing, and you're a legend on Twitter, and founded StockTwits, social leverage. I'm sure there's a million other things I should start off with, but let's. I love talking FinTwit on the markets on Twitter. I know you do as well.
Yeah.
One thing that's always amazing to me is, we sort of assume that everybody's sort of got the same information we do. And when I get questions and comments from people, it's very clear to me that they don't. And so maybe we could just rewind a bit. And how did we get here? How did we get into this crazy, uptrend and then just the brutal last 4 to 5 months? I'd love for folks to just hear your sense of how we got to where we are.
Well, thank you. I'm just such a huge fan of your whole. I've had you guys all on the podcast, but this is the joy of this is what I saw when I saw Twitter, because just as quick as I can. This was Yahoo Finance and ICQ were like the beginnings of this, right? Or ICQ was with AOL.
AOL IM, yeah,
IM. There was BBM, but before that there was Yahoo Finance. So it was just like you and I under fake names,
right?
Yelling at each other on the Amazon ticker stream on Yahoo Finance, desktop only, 20 fucking minutes delayed.
Right, dial up.
Day trading with 20 minutes delayed data, thinking we were YOLO players. Yeah. So that was, you want to know a crash and what this version of the crash is. This is just a mini version of the end of the same thing, which is what I'm scared about. Look, I want tech to come out of this. Tech will come out of this, but this is not good. This is our version of 08 that's happening. Right? The cascade that we saw is different than 2020. It's different than 2018. This is like 08 financial version for tech. And this is not about financials. This is about just plain old supply. There's just so much supply from the last bull market that's gone on since 09 and throw in crypto. There's just too much supply. Like, I don't care how much money you have. Now that the bubble burst, there's just people selling. There's just sellers everywhere. But in 99, we had Yahoo Finance. And then we had nothing. We had CNBC and we were left with Kramer.
It was bleak.
There was E-Trade and that was getting old. And then YouTube came along. And Twitter came along, and there was a fucking explosion of creativity. And what I saw with Twitter was Yahoo Finance 2.0, which was, instead of 20 minutes delayed, it was real time.
Right.
So that was it. Like, I was like all in. I was like, okay, you give me Yahoo with all my knowledge and real time. Twitter's going to be Bloomberg. That was my bet. Yeah. So I kept writing checks into like Bitly and TweetDeck and anything I could real time, and it worked out pretty good.
Yeah.
And I started StockTwits. I went to Jack and Ed and said, "Why don't you do Twitter for finance?" And they were like, "What?" And I had to go build StockTwits,
which is booming.
Doing really well. Yeah. It was not run well by Howard Lindzon. I changed my name. I call myself Lindzon just so people don't know that that's who founded it. But I'm Howard Lindzon.
That's like a friend of mine that used to go out in San Francisco, and during the day at work, he was John, and at night he was Jack.
Yeah, I'm not
people would be like, Jack. He's like, no, that's my nighttime persona.
Yeah. I'm Howard Lindzon, but people know me as Howard Lindzon. But as terrible operator, and but really good at community, which is not a venture business. And someone should have told me that. Maybe my venture capitalist should have told me that. And so anyway, so here we are, and I think we are now experiencing what 99 was, but in real time. So the only difference of Yahoo was everything was delayed, so the crash took longer. Now we have it we're all talking in real time. We're like, oh God, like if he's not selling, I should be selling. And if he's selling, I should be selling. Everybody's selling.
But how did we get into the irrational moment of, let's call it 21, where everybody was buying everything, right? Buying condos in Miami, buying Bored Apes, buying software at 50 times forward revenue. I mean, everything was going up and it felt good, right? For everybody, it felt good. You look around, as our mutual friend Russ Fraden likes to say, everybody's getting rich and it feels good. And then you could sort of start to see cracks in the ointment last fall. But how did we get there and how did we get here? I think that's what I'm trying to help people understand.
I don't know where here is here yet. We know how we got there. So how we got there is, no one should beat themselves up about it. We've all lost money now, but so we have to look and try and preserve, like double down where we're supposed to and preserve capital where we should. Like it is hard selling stuff down 70%. It could be a fantastic sell though. People need to be honest about that, you know? And I'm not going to tell people what to do. Everybody asks me what to do, but like sometimes being down 70% is just the beginning.
Right.
Okay. So people need to know that that's a bear market. I don't know, like you got to be prepared, and I can't manage people's portfolio, but how we got to the bubble is 99 was 20 minutes delayed. And now we're in real time crash. And right. So they're the exact same thing. We're in a crash. It's faster. We don't think it's a crash because it's not fast enough. It's not like a flash crash, and it's not like Black Monday, because everybody's waiting for Black Monday or a flash crash. And I'm like, no, this is just a real-time crash. Everybody's waking up and seeing that everybody else is still selling, so they're selling. And it's happening faster than 99. And so I think the next boom will happen much faster than 5 years or 6 years that it took for the internet 2.0 to come along, or web 2. But we got here because we, in 2020, when it might have started to end, you know, COVID happened. And then you and I started my Stupid Panic podcast, and we were like, I was super bullish just because we weren't dead.
Yeah, I
like
remember March 16th.
You fall off your bike or you get in a car wreck, the first thing you do is like, holy shit, I lived. And I think COVID was like, by May, we were like, fuck it, we lived. And I can write a check on Zoom. And even if I can't, the other guys are. So we got to get back to work. And then it worked. Slack and Zoom and DocuSign and whatever needed to carry us through this, we're working. So we're like, fuck it, we're invincible. And
Peloton and Shopify.
Oh, and then the Fed's stupid, and we'll just take advantage of the Fed, and we'll get PPP loans, and I'll get this. And so I'm saying, like, we all took from the punch bowl. It's pretty much all blood money. And we got sloppy. I don't think it was like anything other than we just got sloppy. No matter how much you sold, because I was selling on the way up, I thought I sold a lot. Yeah. It turns out that I didn't sell as much as I thought I should.
But I think it's also helpful for folks when you say nobody should feel guilty. I mean, the Fed maintained a historically low interest rate. I mean, when I bought my first home in 2004, I think my mortgage was at 7.5%.
Yeah,
you had people buying.
I was
homes.
6.5, and I thought I was the greatest.
Yeah, we had people buying homes for the last few years at whatever 2%. So
but they're also buying humongously expensive homes.
Oh yeah,
my first home was 160 grand at 6.5%, and you know I put 15 grand or whatever down, but it was only 100K note.
Yeah, yeah.
Now kids have $3 million.
So, but this exuberance partly came from really two factors that are sort of out of individuals' control, which is one, Fed keeping interest rates low, which brings money in from the sidelines to say, well, if I can't earn money in a bank account, I'm going to earn it somewhere else, and I might as well YOLO on Zoom stock, as you said, or whatever. The other part of this was we pumped, I think it was $5 trillion or $4 trillion of stimulus into the economy to combat COVID. So the right thing to do initially, but then maybe we overcooked it a bit.
Not only do we overcook it, but the end result of this, and this is what I'm trying to learn on my new Panic with podcast series, which is why you're not invited, because you know nothing about commodities and drill. I need drillers and commodity people on my new show. No, I'm kidding.
So, I went to the dentist this week and got drilled.
So what's happening now, and I'm just trying to make sure I don't get run over by this tidal wave, is we're at peak globalization. I heard this great guy, Lewis Johnson, I sat him on my podcast. He's a really good guy. And he was yelling into the wind for about 2 years about natural gas and commodity cycle, because he's been through this in ags. And now we're on our way to peak deglobalization. Mm-hmm. Hopefully we don't know what that looks like. Yeah. We don't know how small market caps will be in a deglobalized world. It's about shrinkage, that's a Seinfeld thing, but it's about shrinkage. In a world where the Fed is taking money out of the system theoretically, in a world where the government's flipping from right to left very quickly, so there's no policy, and in a world where China's dark and Russia's dark, and maybe Latin America goes dark on us, and the enemies of my enemies, so we're now deglobalized, so your valuation of 100 million is capped because you can't go into China, and you're not going to ever really go into Europe because Europe doesn't want to have another Google and another monopoly. They want to have their own companies theoretically. So I think there's compression multiple. It's just a multiple compression.
So you have QE with low rates, you have stimulus as a response to COVID, and you have this deglobalization trend, which is going to hurt supply chains, potentially drive up costs for things like energy,
it's
oil,
happening.
beef.
And we're in denial. Like we got war.
And why do you think I've tweeted this out a million times, why were our elected officials so naive about inflation last summer and fall?
I don't know, but I mean, in the end, what Lewis said it to me yesterday. He goes, taking the politics out of it, Europe was reliant on energy from a guy that turned out to be a mass murderer. And so they should have seen that. Like, forgetting all our mistakes. It
wasn't just us.
The people that we put in charge were kowtowing to a small percentage of people that were really good at getting decisions made that aren't in the best interest of the majority of us.
Right.
And so now, like, whether it's a wheelchair or a computer that it's missing, it's got 99% of the parts. Or baby formula, it's got 99% of the parts, missing 1% of the parts. So it's sitting. That's a new thing that we didn't have to think about. No matter how good Shopify is or Amazon Prime is, if the parts aren't built, you can't ship it to you. So I think that's where we're at. And that's an unknown. That's the unknown, whatever the warmongers say, but we don't know. Like
I think that's a lot of what's driving the fear in the market right now, is it is an unknown, right? The supply chain issues are a bit of an unknown. The energy issues, the food issues because of Russia and Ukraine are a bit of an unknown.
Yeah.
Geopolitics, unknown.
Yeah.
And oh, by the way, we've got that we really haven't had, at least I've been in Silicon Valley since 1995. We're talking about having a recession when unemployment is low and the economy is ripping. Yeah. Why? Because we have to jack up rates because inflation just spiked for the first time really in 40 years to a level that we've not seen. And it's scary, and it's scaring people because we don't know if anybody knows what to do about it.
Yeah. And then you also have real blowups, like Carvana just laid off 2,500 people. So yes, there's lots of jobs, but when you dump 2,500 people at the same time, it takes a little while. That can hurt. And there's maybe 50 of those companies out there that are going to go again, it's a bigger country and a big economy.
I think I've said this, the tech companies overshot on hiring last year by 10, 20, 30%.
Peloton,
every company,
Robinhood, Coinbase,
every company, not just those companies, even the companies that are doing well. You could walk into Google today and lay off 20% of the workforce and they'd be fine.
Yeah.
We overshot on hiring, and that's going to have to work itself out as well.
Yeah, and then you also have let's not beat up on people too much. Like, mistakes are made, and I run a 500 corp dev teams on Twitter, so it's the joke is like I get to be corp dev of 50 companies.
No, I love your ideas.
I don't get paid, but I get to actually influence corp dev of 50 companies. But you had a period where, like, let's take Robinhood for example, or Coinbase. They exploded or were growing nicely in a non-COVID world. They knew how to hire. They were building offices. You know what I mean? Then COVID happened. Okay, guess what? They were lucky enough that they could also hire. They hit themselves and like, oh, we're alive, but we still got to hire. Or Cloudflare or any of these companies that then did a pretty good job, or they thought they were doing a good job because they were checking themselves every month and they're hiring, and it was all remote. So then they go, oh, but now there's this new world, which is like, you got to know how to hire and recruit in a physical world. And you also now have to hire and recruit in a digital world starting today.
Yeah.
And I think that's a big change because you got to run a team that's like both.
And it's hard.
You can't be just one or the other. So there's a lot of new learning that has to happen.
So
I'm just saying multiple compression is happening on top.
And multiple compression was bound to happen at some point. I think we all sort of acknowledge
we got to get quickly to the reality where every level of investor needs to compress. Right now, seed hasn't compressed yet, but growth has. And public's compressed. So until seed drops 70%, not 20%, 70%, Like, I can't do a deal. Why would I do a deal at 20 pre or 15 pre when it should be 4 pre?
Right.
Because if the exits drop from 10 billion to 1 billion, here's our spreadsheet of what net IRR and DPI looks like until investors start showing founders what this looks like.
Yeah. And the reason I was explaining this last night to someone, a lot of folks ask, well, why have multiples compressed at the growth stage?
Forget why, it just has.
Well, but it's, an anecdote. I have a friend who invested in a company, and I'll skew the numbers a bit. Invested in a company in December at, call it $12 billion valuation. Mm-hmm. The way that they got there was they were comping it to a bunch of public companies that were trading at 30, 40, 50 times forward sales. Sure. Well, when those companies drop down to 15, you look at that deal and say, gosh, that deal today would get done.
Plus it's a liquid.
And it's a liquid. Right. So that deal maybe today gets done at 3 billion. So the investors who've been participating in those investments are now looking at the market and saying, gosh, I've got to recalibrate the way I'm valuing these companies and the potential future upside in my exit. And I got to do a reset on valuation. And so they're doing that. Yeah. Why has that not made its way into earlier stage?
Human nature. They don't want to mark shit down. No one wants to come to grips with reality. Luckily, I'm a seed investor, and I know that I'm going to be in a business for 10 years. So 14 months ago, I stopped writing checks because the valuations made no sense, because we had DPIs. Look, I was in Robinhood, I was in Customer, I was in eToro, I was in Wallstrip. I've seen exits, and I've done the math and returned.
So along the way, just for folks who don't know,
we need people that have returned capital.
For folks who don't know, DPI is.
Oh, sorry. Yeah. The only thing that matters, how much cash you've returned to somebody.
As the founder of our firm likes to say, I can't eat IRR.
You can fucking eat it. You can eat it up until about 6 months ago.
Yeah.
And now you can't, but you can never eat IRR. DPI matters, which is how much you've returned to your investors. And this was another problem that was going on, but we don't have enough time, is that we went from 99 where people got smacked and Fred Wilson of the world, and I realized something goes public, return money to the investors. We're not public and private managers. And then we all saw the Twilios and the Squares. We're all guilty. We're all human. And people sold Shopify early, right when it went public. And then we got conditioned to hold, and then we were public private. And then the crossover thing became a thing again. And
it was easy money.
People need to specialize, jujitsu. And we all became, and FinTwit we all have these expert networks at our fingertips. So we learn quicker than we've ever learned. But investing is hard. So crossover is hard. And it's hammered Altimeter. It's hammered everybody in growth. And we have friends that it's hammered. And it's because crossover investing is hard. Multi-stage investing is hard.
Yeah.
There's so many Dan Loebs. There's only one Dan Loeb, because being Dan Loeb's fucking hard. Even Dan Loeb can't be Dan Loeb, is what I tell people. So it's like, the era of like sticking in your lane, as much as we don't like tell people to stick in their lane, there's value to that.
So let me jump in and ask you two things, two different personas. One, what advice do you have for founders right now? Because we're going through a shift that most people who are under the age of 50 have never seen before, under the age of 40, certainly have never seen before. And it's hard to get your head around. So what advice do you have for founders? And then secondly, what advice do you have for individual investors?
Okay. So the first one, luckily, our founders that we just had a call with yesterday that showed up at least, was congratulations. You listened to us.
You're alive.
You're alive. And congratulations. You took money at social leverage valuations, which means you're fine. Like if you execute the way you thought you were, people are going to be happy to do your next round because it wasn't overpriced. So you had all this, you were stressing these companies out, and both sides are to blame. Giving someone money at 20 just so you can win the deal is putting so much momentum stress in a business in an early stage. Momentum is should be coddled and protected. And there's a moment earned, but it wasn't being earned. And when it breaks, it's so ugly. So if you're going to risk all your momentum at an early stage, that's just gambling. You might as well trade options. So what I tell founders is, if it's a down round now, do it the sooner you can do your layoffs, and the sooner you can do your down round, do it. Recap. And hopefully your first recap's the easiest. But if you have enough money and you think you grow, just get the team focused on understanding multiple compression. If Zoom's down 70%, and I love Zoom and I own Zoom, and Coinbase is down 80%. and Twilio's down 80%, and Cloudflare's down 75%. If you don't think your private company is not down 90%, you're lying to yourself.
Right.
I know that's a hard thing to take. So I luckily can trade stocks not well, but if I can YOLO liquid options or YOLO public stocks for the same type of returns over 4 years that I can do from a private company, but have the liquidity with me, that's the thing. So what I tell founders is take the medicine early. Just be honest. Tell us how you guys think about your business. But luckily, we back companies with we lead C checks, so we beat them up. They thought we were beating them up, but
so they were prepared. That's good.
They were prepared. We do deals under 10
But your advice,
valuation.
if you're a founder that's sitting at maybe a little bit of a scary valuation, one of the ways I've described this is if you know a public stock that went from 80 to 20, the CEO doesn't get to debate whether the stock is at 20.
Right.
Stock's at 20.
Yeah.
If you're a private company and you raised money at 80, assume your stock is now at 20.
Yeah.
And go out to raise capital with that as the mentality, and it's okay. It's okay.
Talk to your investors and say, what could you live with? Because we think we should recap now, or at least raise around at the same price or 20% discount. So just get it all. Let's work together as a company. And I think the problem that we have is there's so many 100K investors, and so there's going to be this orphan society of companies and new managers that walk away, and you know that's the way it is. And in a world that we live in a pre-cloud world that you and I grew up in, businesses failed. 90% of businesses failed because gross margins were terrible. There was very few high gross.
Yeah, we had to build our own infrastructure.
Non-cloud world. Now we live in a world where everybody's in business and everybody has high margins, and so businesses won't fail as much. So don't confuse failure with recapitalization.
What about for individual investors who are trying to understand the markets?
Individual investors, they all think the market's rigged. Guess what? Congratulations. You now know what everybody else who still invests knows, that the markets are rigged. The faster you learn about public, this goes to StockTwits, Twitter, Robinhood, Coinbase, whatever you want to use as your first portfolio builder. Whether it's one share or a quarter of a share, build a portfolio. You know, they say, you know, when you go to Israel, you go to the Dead Sea the first time, they say, don't go in the water if you have a cut, because the salt will fucking burn. So the best way to invest is, assume you're going to get burned, by invest as much as you can afford to lose without killing yourself or hurting yourself, and do it. And then see what happens. See how you behave with that. Start watching prices, so that you get a feel for the mood of the world and the economy and this, because it's about moods. And when you see 20 red days in a row, guess what? You will start getting accustomed to doing the opposite of panicking. You will start saying, oh, I know what comes after 20 red days, some green days.
Exactly.
And I know what comes after 200 red days, a long time of green if you live in America. So you have to start getting used to, and the only way to do that is to own public stocks. And
then would you recommend folks dollar cost average, i.e. keep buying on a consistent basis? If you like names, keep adding to that Wealthfront account, keep adding to that Robinhood account. Yeah.
So the other thing is, and there's no one right way, right? But the other thing that I recommend is, I forget, I'm old. But the other thing that I recommend
indexing.
It's not so much that they're dollar cost investing. It's that they're constantly curating their portfolio. Like you have to just clean it up once in a while. I know it sucks, but you have to sometimes just sell stuff at a loss and move on to another company and whatever. Don't own too many things. So the other thing you'll learn by doing is you'll be in a green market for months and you go, fuck, I own 700 companies. I'm like, who can manage that? So I think once you get above 20, it's almost too much. This
is an important point. A lot of people don't understand this. Some of the best fund managers in the world, they only own 6 to 10 names.
Yeah. And we all are guilty in a bull market of ending up with I'm in weed and I'm in this and I'm in that and I'm in industrials and I got some gold. I'm like, what?
Yeah.
So
I'm guilty. I trimmed a few the other day. I'm like, why am I even in this?
Yeah. And so we are in that phase now. And I think people just have to be honest with themselves. And I don't think it's money. I don't feel good about taking losses, and no one should, but we got to curate and clean And this is going to take a little while. Hopefully in a real world like Twitter, people will do this much faster. I mean, I got to be honest. This is the first time I've seen anything like this. Like, I still think Zoom and Twilios in this world are overvalued, but at least we're 70% of the way there, if not 80. So I can live in the last 20%. So that's good. It'd be better than just seeing it drop 1% a day for 3 years.
Well, I think I agree with you on that. And it's interesting. Josh Brown had this great quote where he said, if you're 75 and your retirement account just went down by 50%, you should be upset. Yeah. But if you're 25 and your Robinhood account, you should be grateful, because now you've got a generational reset and an opportunity to invest for the next 5 to 10 years at much more sane levels than where we were 12 months ago.
And you learn. So the other thing has always been the language of the markets. So I'll use Chinese as my example here, as I always use. If someone said you could learn Chinese in 3 months, you would sign up for that. In a globalized world, you would say, fuck, I'll learn Chinese.
Hard language to learn, but
any language. But you said we can learn that. I just use Chinese because it's a fucking hard language.
Yeah.
Okay. And that's the market. Very hard language. Okay. So if someone said you can learn Chinese, oh, by the way, you think you've learned Chinese in there, but we're going to drop you off in the middle of fucking one of these big Chinese cities with no cash, with the Chinese you thought you learned in 3 months. See how far that gets you. And that's what that's what COVID investing was. Yeah. We're going to give you money and an account and a green up market. Guess how much you learned?
Yeah.
Chinese.
Yeah.
So the good news is that now we've onboarded 100 million people. 50 million will get weeded out, but at least there's 50 million more people that will provide liquidity to the system. And what the media is, what we're all doing now is trying to protect people from themselves. No. This was like learning Chinese. We should encourage people to learn this language. We shouldn't socialize these losses. I'm not saying it was all good, but Jesus Christ, we got kids gambling on the weekends with parlay bets. I'd rather them learn investing.
It's a great point. If we end up with a whole generation of investors that very quickly learn some hard lessons, they're going to be much better off in 5 or 7 years. That's a great way.
What do we not want people to learn and just have a Japanese market where the government owns everything? Yeah, so we need to embrace these losses, talk about them, educate ourselves about fear and greed.
Which is why I love people being open. You know, Brad, you probably saw Brad from Altimeter this week tweeted out. He said, hey, look, we got our face ripped off this year. I love that because it helps people understand. It's like startup failure. I always hate it when 99% of the articles are positive about startups. I'm like, guys, 99% of companies aren't successful. 99% of investors aren't successful. We need people to come out and say, hey, I got my face ripped off this year. It's been brutal.
I got my face ripped off last year, relatively speaking, because I was selling and the NASDAQ was up 30%. And the people that like follow my idea, like my 8 to 80 portfolio were like flat. And I'm like, because I was 80%, 70% cash. Okay. This year I got ripped off in a way because I killed myself, because the 40% that I stayed long is down 80%.
Yes. Yeah.
So I'm saying like lessons are learned. So yes, the one thing that Brad and I and other people do, we gloat on the way up, or we're all guilty of that, but we also are willing to just say, look at me, I'm an idiot. And we need other people for the markets to work. We can't socialize these losses. People need to take these losses, and we need to teach this language because it provides liquidity for a better market. There'll still be scams.
Agree, 100%.
Still be greed and fear. There's still going to be too much supply in the next bull market. But at least people know the language.
They learned.
They know the language.
We got 1 minute left. Let me ask you a question. Where do we go from here? What happens next?
I think it's going to be tough because of supply. I just want, there's so much private supply too. And people with interest rates higher. I just think the money is going to stay in the system. That's a good thing. The S&P is not down 50% yet. And I don't think it will. Or I don't think the NASDAQ goes down 80% because there's not enough public companies. So I think we're okay. But I think we also need to learn other markets. Like we need to solve supply chain stuff. We need to supply climate. There's carbon, there's energy, better energy, tech and energy. So I'm worried and I'm trying to learn that the same trick won't work again. Tech will work, but it's got to be expressed in many different industries and in many different ways. It won't be the same stuff that works.
So but the enterprise will work, but the challenges we have with supply chain labor, materials are going to take time. You think the
and we need to invest in them because of
Yeah.
scale. Like the world's deglobalized, so every country is going to need it.
You think at the end of the year the market's higher than where it is today?
No, I think it's much lower. No, I think the markets have a chance. The indexes have a chance to be much lower, but I think good investors will do well from here.
Yeah, there's opportunity now.
Huge opportunity.
Yeah.
Just the last 2 days, you crushed it if you own the right companies. But I think you have to just understand markets better. I think people like me who understand markets have a way better chance. And I think founders that really learning public markets, it's not too late. Start. If you're not following the prices of the best companies in your industry, you're really not doing your job as a CEO.
Yeah.
Yeah.
Good to catch up. I hope I didn't keep you from something important like, I don't know, what, golf game, burrito lunch?
There's two things I do. If I'm not here, I'm manscaping or just staring at the screen going, how much have I lost? How much have I lost today? I really have a simple life. No. I work and I bike.
Where are you? Are you in Scottsdale?
I'm in Phoenix.
Okay.
I'm in Phoenix, and it's getting a little hot here. We go to San Diego in the summer. And my kids, I'm an empty nester, so life is good.
I'm on the opposite end of that.
The Suns game 7 on Sunday. I mean, they really haven't looked good.
We got the Warriors tonight.
You got the Warriors tonight.
Yeah.
They'll win.
They need to win.
No, they'll win. But they that's the type of loss that you follow up with a win.
Suns are playing the Mavericks, right? They lost last night.
They lost. They've looked. They're Jekyll and Hyde.
But it's a home game next.
Doesn't matter. Only one game.
Yeah, Luka's tough.
You don't give Dallas a shot like that.
Luka's a generational talent. Great. I love watching that guy.
When I see Luka drive, I go, Jeff Richards
driving
to the hoop.
Trust me, in my wildest dreams, I didn't look.
He's like Magic and Larry Bird and George. Like he's swagger and like obnoxious and like flops and shoots. He's really good. He's quick. He's. I hate and I've become a little bit friendly with Spencer Dinwiddie, so it's like I hate that I like the enemy.
Yeah, well, they've got a lot of talent in Phoenix too. You got Booker, and I mean, what?
Yeah, Paul's playing either injured or tired.
Yeah,
and Booker hasn't played like an MVP, and so we're not playing our game. We were better last year, so we'll see. Warriors would kick our ass.
And so, and any chance you're going to go join the LIV tour over in Dubai with Mickelson and Greg Norman?
They're not right wing enough for me.
They haven't invited you.
If they were more into money, I would. But I just
my God, talk about destroying reputations.
I just think they're not
embarrassing.
Embarrassing. But he may have gambling problems.
Maybe. That's what I hear. Yeah. All right, man. Have a good weekend. It was great to see you. Thanks for doing it.
See you, everybody.